Most traders fail because they think trading is about being right. They believe the goal is to find some magic system that predicts the market with near-perfect accuracy. This is why they hop from one indicator to the next, one strategy to another, chasing the illusion of certainty. But the top 1% of traders know the truth. Trading is not about being right, it's about managing probabilities. When you understand this, everything changes. You stop needing to win every trade. You stop feeling like a loss is proof that your strategy doesn't work. You start to think like a casino owner, not a gambler. Casinos don't care if someone wins a hand at blackjack. They know that over thousands of hands, the odds are in their favor. The top 1% of traders think exactly the same way. The problem is, most traders know this intellectually, but don't live it in their trading. They still take losses personally. They still get emotional when a setup fails. They still increase their lot size impulsively after a win, or skip a trade after a loss. The probability mindset isn't just about knowledge, it's about rewiring how you respond emotionally to outcomes. In 2002, a trader named Mark Richardson started with a $10,000 account and a simple trend-following system. He had an edge that worked about 55% of the time, with a 1-to-2 risk-to-reward ratio. On paper, this was enough to make a fortune. But for his first year, he barely broke even. Why? Because every time he had 3 or 4 losses in a row, he would stop taking trades, convinced something was wrong with the system. And inevitably, the very next trades, the ones he skipped, were huge winners. He had the probabilities on his side, but couldn't execute consistently because his mindset wasn't aligned with the math. This is the trap most traders never escape. They want every trade to work, and when it doesn't, they make it about themselves instead of the probabilities. But the top 1% separate their identity from the trade. A loss doesn't mean they're a bad trader, it's simply one data point in the game they're playing. Think about a coin toss. If a coin lands on heads 60% of the time, and you're betting on heads, it's still completely normal to have 5 tails in a row. That doesn't change the fact that if you keep betting on heads over hundreds of tosses, you'll make money. Trading works the same way. The market is just more complex than a coin toss, so the probabilities are hidden in patterns, setups, and risk management rules. One of the most important mental shifts is accepting that you can do everything right and still lose a trade. A perfect analysis, a flawless entry, and the market can still reverse against you. That doesn't mean you were wrong, it just means that probability played out against you this time. The top 1% don't waste energy fighting this reality. They embrace it. They expect it. In 2015, during the Swiss franc shock, many traders were wiped out in minutes. The market moved so fast that stop losses didn't trigger at expected prices. Some people swore off trading forever, claiming the market was too unpredictable. But the traders in the top 1% didn't panic. They already knew the market could throw curveballs like this, so they kept their risk small enough that even a freak event couldn't take them out of the game. They didn't need to recover, they simply absorbed the loss and kept going. That's the core of the probability mindset. Survival first, profits second. If you blow up your account, you're out of the game. The top traders are obsessed with staying in the game long enough for their edge to work. They know a good system plus disciplined execution will inevitably make money over time, but only if they're still around to place the next trade. The probability mindset also kills the need for revenge trading. If you see the market as a series of independent events, there's no need to make back what you lost on the last trade. That's emotional thinking. A top 1% trader sees each trade as separate from the last, with no emotional debt to repay. Adopting this mindset takes more than reading about it. You have to train it. Keep records of your trades. Track not just wins and losses, but whether you followed your plan. Focus on executing well, not on whether a single trade made money. Over time, you'll see that the traders who win consistently aren't the ones who predict the market best. They're the ones who execute their edge relentlessly, through both good runs and bad runs, without flinching. In the end, the probability mindset is the foundation of thinking like a top 1% trader. Without it, you'll forever be tossed around by the emotional waves of the market. With it, you'll navigate calmly, knowing that a single trade means nothing, but the next 1,000 trades mean everything. The difference between a good trader and a top 1% trader is rarely found in the strategy itself. Most strategies work under certain conditions. The real edge comes from patience, the discipline to wait for the right conditions, no matter how boring or frustrating the wait might be. Patience is not just a virtue in trading, it is an active weapon. The markets have an endless stream of opportunities, but most of them are traps. A top 1% trader can watch 10 tempting setups in a row and not take any of them if the conditions aren't perfect. They are like a sniper, waiting for a high-value target to appear in the crosshairs, not a machine gunner spraying bullets at everything that moves. This kind of patience is difficult because it runs against human nature. We crave action. We equate being busy with being productive, and in trading, that mindset is deadly. Many traders blow their accounts, not because they lacked knowledge, but because they couldn't sit still. They saw a candle spike or a news headline flash, and felt an irresistible urge to be in the game. The top 1% trader is immune to this impulse because they have rewired how they see the market. To them, not trading is still trading. It's a conscious decision that protects capital and maintains psychological balance. Consider what happened in the early 2000s during the dot-com bubble. Internet stocks were skyrocketing daily. Traders who had no idea what they were doing were doubling their money in weeks. People quit their jobs to trade full-time because this time was different. The top 1% traders knew it was a mania. They watched from the sidelines while others mocked them for missing out. Then, when the bubble burst in 2000 and the Nasdaq lost nearly 80% of its value, these patient traders stepped in and bought companies at a fraction of their former prices. They didn't get caught up in the noise. They didn't need to be part of every rally. They knew that markets always give second chances to those who wait. Patience in trading isn't just about waiting for the market to give you a perfect entry. It's also about waiting for your own emotions to be in the right place. If you've just had a losing streak, your judgment is clouded. If you've just had a big win, overconfidence can creep in. The top 1% trader knows that their mindset is part of the setup. If they're not mentally ready, even a perfect chart pattern can turn into a loss because they'll manage it poorly. They'd rather skip a trade than take it in the wrong state of mind. This is where patience becomes more than just timing the market. It's about timing yourself. In 2011, during the European debt crisis, the euro was swinging wildly against the dollar. Many traders tried to catch every move, thinking volatility meant easy profits. They forgot that volatility cuts both ways. The top 1% traders were patient. They avoided the choppy middle and waited for moments when the market reached extreme overbought or oversold levels. Then they struck with precision, taking trades where the odds were clearly in their favor. They didn't care if they only traded once or twice a week. What mattered was that when they did, they entered with confidence and held without panic because the setup was undeniable. The challenge for most traders is that patience feels like doing nothing, and doing nothing feels like failure. In reality, waiting is the hardest form of discipline because it requires you to suppress the part of your brain that wants instant gratification. The market is a master manipulator. It will tempt you with half-baked setups and make you feel like you're missing out. A top 1% trader doesn't measure success by the number of trades taken, but by the quality of those trades over time. They understand that capital preservation comes first, profit second. Without capital, you can't trade. Without patience, you can't preserve capital. I once knew a trader who specialized in gold. His entire yearly profit often came from just 4 or 5 trades. He would wait months for price to reach a certain long-term support or resistance level, confirmed by multiple time frames. He didn't care about missing all the little moves in between. He knew that when the market aligned with his criteria, the move would be big enough to justify the wait. While others were grinding out dozens of trades and paying thousands in spreads and commissions, he simply waited and then collected massive profits when his moment arrived. His patience wasn't laziness, it was strategic discipline. Patience also changes how you handle losses. An impatient trader, after losing, will rush to make the money back. This is where revenge trading happens, and it's one of the fastest ways to blow up an account. The top 1% trader treats a loss like a data point. They don't immediately re-enter the market. They wait until the next high-probability setup forms. They understand that rushing is the enemy of good decisions. Patience turns a loss into a lesson, while impatience turns a loss into a disaster. One of the most famous examples of patience paying off was Jesse Livermore, the legendary trader from the early 1900s. He would often sit in cash for long periods, simply observing the market. When the conditions matched his criteria, he would take massive positions and hold them for weeks or months. This is how he made his fortune during the 1929 stock market crash. Everyone else was panicking and trading frantically. Livermore had been waiting for that exact scenario for years. When it came, he acted decisively, but only because he had the patience to wait for the market to come to him. Patience is not passive. It is the art of selective action. A top 1% trader is always watching, always preparing, always refining their plan. They are not asleep while they wait. They are analyzing, building scenarios, and rehearsing their responses. This mental preparation means that when the market does align, they are ready to execute without hesitation. Most traders do the opposite. They act without preparation and then hesitate when the moment comes. Patience in trading is the bridge between preparation and execution. In the end, patience works because it gives time for probability to stack in your favor. Every market move is a mixture of randomness and structure. If you act on the random parts, you're just gambling. If you wait for the structured parts, where price aligns with your strategy and the broader context, you're trading with an edge. The market will never reward impatience in the long run, but it will always reward those who wait for the right moment, again and again, without getting tired of waiting. That is why the top 1% trader doesn't fear boredom. They embrace it, because boredom is the shield that protects them from bad trades and keeps them in the game for years. The trader who can master patience is already ahead of 90% of the market. The challenge is not learning a new indicator or memorizing another chart pattern. It's training yourself to delay gratification, to act less often but with more conviction, and to be okay with long stretches of waiting. Once you internalize that waiting is part of winning, you stop chasing every candle and start thinking like the elite. You realize the market is not a sprint but an endless marathon, and the runner who stops to rest and wait for the right moment will always outlast the one who sprints until they collapse. The mindset that separates the top 1% trader from the rest is not just patience or discipline, it is embracing uncertainty with confidence. The markets are unpredictable by nature. No one can forecast the future with absolute certainty. Anyone who tells you otherwise is either lying or fooling themselves. The elite trader understands this fundamental truth and builds their entire approach around it. They don't waste time chasing certainty because it doesn't exist. Instead, they focus on controlling what they can, their risk, while accepting that losses and surprises will come. Most traders live in denial of uncertainty. They want the market to be predictable, neat, and orderly. They crave certainty because it feels safe. But the moment the market refuses to behave as expected, they panic, double down on bad trades, or quit altogether. The top 1% trader takes a radically different approach. They see uncertainty not as a threat but as the very fabric of opportunity. Every uncertain moment is a chance to profit, provided they manage risk properly and stay mentally prepared. Think back to 2008 during the global financial crisis. The markets were chaotic, and prices swung wildly every hour. Many traders froze or lost everything, trying to guess the next big move. Yet, some top traders thrived precisely because they accepted uncertainty. They didn't pretend to know where prices would go. They prepared for multiple scenarios and sized their trades so that no single loss could wipe them out. When the dust settled, these traders had captured enormous gains from price moves no one saw coming. How do you embrace uncertainty without losing your mind? The answer lies in shifting your focus away from predicting the market and toward probabilistic thinking. Instead of thinking, the price will definitely go up, the top trader thinks, given the conditions, there's a 60% chance the price will go up and a 40% chance it will go down. This mindset change seems subtle, but is revolutionary. It frees you from the need to be right all the time. You accept losses as part of the game because you know you are playing the odds over many trades. In 2015, the Swiss National Bank shocked the world by removing its currency peg to the euro, causing the Swiss franc to jump dramatically in minutes. Many traders who thought they had certainty around the peg were wiped out. The elite traders, however, had already planned for extreme volatility. They accepted that the peg was not guaranteed forever and managed their risk accordingly. They didn't need to predict the exact moment of the shock. They only needed to be prepared for the possibility and adjust their positions so that even if the worst happened, they would survive and thrive. Embracing uncertainty also means having the courage to cut losses quickly. No trader can win every trade. The top 1% trader knows that holding on to a losing trade out of hope or stubbornness is the fastest way to lose everything. Instead, they use stop losses and mental discipline to exit losing trades before losses grow too large. This behavior is hard for many traders because it feels like admitting defeat. But the top trader views cutting a loss as winning in the bigger picture, preserving capital and emotional balance for the next opportunity. Another essential part of handling uncertainty is diversifying your approach. The market environment constantly changes. A strategy that works brilliantly in a trending market might fail miserably in a sideways market. The top trader doesn't rely on one single method or one single market. They have multiple strategies, timeframes, and instruments they can switch between depending on the conditions. This flexibility means that no matter how the market surprises them, they have a tool to respond effectively. Consider the legendary trader Paul Tudor Jones during the 1987 Black Monday crash. He didn't predict the crash's exact timing, but he was watching the market's signals and had a flexible plan. When volatility spiked, he shifted from a cautious stance to aggressively shorting equities. He managed risk tightly and took profits quickly, demonstrating that embracing uncertainty means being ready to change your mind and your positions in response to new information. One of the biggest psychological hurdles in embracing uncertainty is the fear of missing out. FOMO. When the market is volatile, everyone feels the pressure to jump in or risk losing a chance for profit. But the top 1% trader knows that FOMO is the enemy of clear thinking. They have learned to detach from the emotional need to be right or make money now. Instead, they trust their process and accept that missing a trade is better than losing money on a bad one. This detachment frees them to make rational decisions based on risk and probability, not emotion. Uncertainty also forces you to rethink your relationship with control. Many traders believe they can control outcomes if they work hard enough or analyze long enough. The truth is, no one controls the market. The top 1% trader controls only one thing: how much risk they expose themselves to on each trade. They use position sizing, stop losses, and risk limits to ensure that no single trade or series of trades can destroy their account. This mindset shift from trying to control the market to controlling risk is fundamental. In the mid-1992, during the Asian financial crisis, many traders tried to fight the panic selling in currencies and equities, thinking they could predict the market bottom. They lost huge sums betting against the tide. The top traders, meanwhile, managed risk carefully and waited for signs of stabilization before entering. They didn't need to be sure when the bottom was. They only needed to protect themselves until it came. This allowed them to enter with confidence when the opportunity arose, while others were still trying to force certainty. Another lesson from embracing uncertainty is that consistency beats heroics. Top traders don't need to make huge, risky bets to succeed. Instead, they take smaller, high-probability trades with defined risk. They accept that many trades will be small winners or even small losers. Over hundreds or thousands of trades, this consistency compounds. Chasing big wins with reckless certainty is a fast track to failure. The top 1% trader understands this and embraces steady, measured progress over time. In 2013, the cryptocurrency market was in its infancy and extremely volatile. Many traders jumped in hoping to get rich overnight. The elite traders who embraced uncertainty approached the market cautiously. They allocated only small amounts of capital, used tight risk controls, and focused on learning rather than winning big immediately. When the market exploded years later, their consistent approach had preserved capital and knowledge, allowing them to capitalize on the boom safely. Finally, embracing uncertainty requires mental resilience. The market will test you. You will lose money. You will face unexpected events. The top 1% trader prepares for these challenges mentally and emotionally. They accept that losses and surprises are inevitable and that the key is not avoiding pain but managing it without breaking. This mental toughness allows them to stay calm, follow their plan, and bounce back stronger after setbacks. Uncertainty is the only certainty in trading. Accepting this fact doesn't make trading easier, but it makes it realistic. The top 1% trader's mindset is built on humility, adaptability, and control over risk rather than control over outcomes. They don't need perfect knowledge because they know that no one has it. Instead, they build a framework to survive and thrive amid chaos. This mindset is the foundation for consistent profits, long-term success, and a trading career that can weather any storm. The ultimate mindset that defines the top 1% trader is unshakable discipline. Discipline is what turns knowledge, skills, and strategies into real, consistent results. It's the invisible force that keeps a trader grounded when emotions scream to do otherwise. Without discipline, even the best analysis, the sharpest tools, and the most promising setups fall apart. Discipline is not simply following rules. It is a way of thinking and being, a commitment to yourself and your process that is unwavering, no matter what the market throws at you. It means showing up day after day, ready to execute your plan exactly as designed, without chasing losses, overtrading, or bending your rules to fit your hopes. The top traders know that discipline is not a one-time decision but a continuous habit cultivated over time. This mindset starts with trusting the process. You can't control the market, but you can control how you trade. When you develop a tested trading system, one with positive expectancy over the long run, discipline means sticking to it even when the immediate results frustrate you. The top 1% trader resists the urge to abandon their plan after a few losses, or to jump into risky, sure things that aren't part of the system. They understand that profits come from consistency, not luck or impulsiveness. Discipline also means managing your risk no matter what. You never let a single trade threaten your entire account. This is not just a rule, it is a mindset of preservation. The top traders protect their capital as if it were their most valuable asset, because it is. No matter how tempting a trade might look, they refuse to over-leverage or risk more than their plan allows. This mindset gives them freedom to stay in the game longer and benefit from the compounding effect of small, consistent wins. Equally important is the ability to control your emotions. Fear, greed, impatience, and hope are the biggest enemies of disciplined trading. The top traders don't deny emotions. They acknowledge them, but they refuse to let emotions drive their decisions. They train themselves to remain calm and objective, even during high volatility or losing streaks. This emotional control comes from a deep understanding that trading is a long journey with ups and downs, not a quick get-rich scheme. Part of this emotional discipline is the willingness to accept losses gracefully. The top 1% trader knows that losses are inevitable. The difference is in how they respond. Instead of letting a loss trigger frustration or revenge trading, they take it as valuable feedback, learn from it, and move on without hesitation. This ability to accept losses without letting them spiral out of control is a powerful mental skill that separates winners from the crowd. Another crucial aspect is patience. In a world addicted to instant gratification, the top traders are patient masters of timing. They wait for the right setups, the perfect confluence of factors, and never rush into trades out of boredom or FOMO. Patience also means waiting for trades to develop fully and not exiting too early out of fear or greed. This mindset transforms trading from gambling to a strategic game where timing and discipline produce results over time. Discipline extends beyond just executing trades. It includes daily routines and habits that build consistency and mental strength. Top traders commit to constant learning, reviewing their trades objectively, journaling performance, and refining their approach. They know that discipline in preparation and reflection translates into discipline in execution. Without these habits, even the best intentions fall short under pressure. What does discipline look like in practice? It's refusing to add to a losing position no matter how confident you feel. It's following your stop loss without hesitation, even when you think the market will turn back. It's limiting the number of trades per day to avoid burnout or impulsive decisions. It's taking breaks when your mind is tired, rather than forcing trades out of boredom. These small daily acts of self-control add up to big long-term advantages. Discipline also means being honest with yourself. The top trader regularly assesses their own weaknesses and biases without excuses. They know when to sit out of the market because conditions don't match their edge. They admit when they don't understand something and seek to improve. This self-awareness is a cornerstone of disciplined trading. It prevents arrogance and overconfidence from destroying years of progress. The challenge of discipline is that it requires sacrifice and consistency in the face of temptation. Markets are designed to trigger emotional responses. They offer constant noise, instant feedback, and the illusion of control. The top 1% trader builds mental defenses to resist these traps. They create routines, reminders, and support systems that keep them accountable to their plan. Ultimately, discipline is freedom. It frees you from emotional roller coasters, from reckless decisions, and from the destructive cycle of hope and fear. It frees you to think clearly, to act decisively, and to trust your process even when the market tests you. The top traders don't trade to win every time, they trade to win over time, and that requires discipline above all else. If you want to join the ranks of the top 1% traders, start by making discipline your highest priority. Build systems that enforce it, habits that reinforce it, and a mindset that embraces it no matter the circumstances. Discipline is not glamorous, but it is the foundation of every great trading career. If this chapter helped you understand the power of discipline in trading, make sure to subscribe for more deep insights like this. I share practical strategies and mindset shifts that can transform your trading journey. Before you go, I want to hear from you. What's the biggest discipline challenge you face in your trading, and how do you try to overcome it? Drop your answer in the comments below. I read every single one and love hearing your stories.